Markets are bouncing after a volatile stretch, but today we're shifting from the noise of the headlines to a topic that matters in every single market environment. We're talking about asset location. It's not just about what you own, it's about where you own that determines how much of your wealth is truly yours after taxes. Today, we're going to unpack how managing the net value of your accounts can improve long-term outcomes and how biblical stewardship calls us to think intentionally about what's been entrusted to us.
Yeah, thanks, Cole, and welcome to the Wealth and Wisdom podcast where intentional planning meets eternal perspective. I'm Brian Cochran here with John Moore Associates, joined by my colleague Cole Leonida. Before we dive into today's discussion on asset location, let's start with just a brief summary of what's happening in the markets over this last week. Last week, the markets ended lower, mostly due to Friday. Tariffs were back in the news, and that made the S&P finish the week down 2.4%. The NASDAQ was down about 2.5%, and those smaller companies, the Russell 2000, were down about 3.3%. That happened, of course, because Cole and I spent last week talking about how the Russell 2000 is an area of opportunity, so it quickly dropped 3%. But that bumped the VIX, which is a measure of volatility, above 20 for the first time in a while. You know, we've been talking about this market being complacent, just sort of steadily rising, and that changed quickly last week. Interest rates declined as well, which means bond prices were up. People were moving to safe assets, and the 10-year Treasury ended just over 4%. That'll be a big headline maker if that can drop down to the threes. We haven't seen a 3% Treasury in quite some time. Inflation remains sticky. We're still seeing inflation numbers that are problematic, especially in the areas of shelter, insurance, and services. Anybody who's renewed their homeowners or auto insurance is not surprised to hear that. It's been a big pain point for many of the families we serve. And we're still waiting for more updates on Fed policy. Powell referenced recently this idea of staying higher for longer. There's this anticipation that rates will steadily decline over the next year. So it'll be interesting to see if future Fed comments suggest that maybe that's not the direction we're heading. If inflation remains problematic, maybe we'll see a couple rate cuts and then a plateau. Time will tell. We also had some consumer data come in last week, Cole, and that showed that sentiment is on the decline, that consumer sentiment continues to be an area of concern. That consumers, between the pressure around income versus expenses, the higher inflation, now you've got government shutdown, there's a lot of reasons for consumers to be a little anxious right now. We had the lowest reading since May. So that could be an indicator that maybe retail sales could be on the decline shortly, maybe economic activity could be sluggish. That could also be a symptom of, Cole, what you and I have talked about before, is the K-shaped economy, where you've got sort of the upper echelon of income earners and folks with high net worth. They're doing great. You know, they're living large, their portfolios are up, their assets are up. If you own a lot of real estate stocks, bonds, you're feeling pretty good. But for the bottom half, or bottom probably 2/3 to 3/4 of American consumers, things are tight, right? There's higher credit card balances, defaults on auto loans. So we're seeing that pressure show up in consumer sentiment. And of course, the big headline last week that drove markets, the word tariff came back in the news. So Trump came out on Friday declaring that China is still pushing back in trade negotiations. We have China implementing restrictions on rare earth minerals, which are huge for our high-tech world we live in today. And Trump is now threatening just an ongoing trade war. And so that pushed down some of the major semiconductor and chip makers, folks that have been really on the rise. Some of those stocks dropped significantly on Friday. The good news is here on Monday, we are seeing a bit of a bounce back in some of those companies. So maybe this will be short-lived volatility, but a good reminder that even if things are strong on a good trend, you can get short-term news that drives stocks down very quickly. So big takeaway, still kind of that stagflation environment, inflation higher than we want it to be, growth a little slower than we want it to be. Consumers are seeing that. And volatility always comes back, right? We had several weeks of easy markets, and then you get this knee-jerk reaction to a bad headline, a bad comment coming from the administration. So we're still in the stock market, right? It's still going to be volatile. So we still want to be cautious, diversified, and well-balanced. So with that summary, Cole, you want to transition us a little bit, and we'll talk about this idea of asset location that you introduced at the kickoff there?
Yeah, I'd really like to because I think this is an often overlooked piece of portfolio construction and overall financial planning that's a regular topic of conversation as we're putting together portfolios in our investment committee. And it's not just about asset allocation, the stocks to bonds to precious metals or cash or where you're allocated in terms of different asset classes. It's what tax treatment is tied to the account types that hold those different assets. And so the big buckets here, we have the pre-tax bucket. Think about your IRAs, your 401ks, your 403bs. We have the Roth after tax bucket that's never going to be taxed again. We can kind of think about it as tax free moving forward. Your Roth IRAs, your Roth 401ks, your Roth 403bs. Then you also have your taxable accounts, things like revocable living trust accounts, your individual brokerage accounts, your joint accounts. Those are all taxable, and we can kind of unpack how those work. But it's very important to think about where you want the different assets that you own to be located, and some of them work better in the pre-tax bucket where you're deferring taxes until later. Some might be better in the Roth bucket, and some might be better in the taxable bucket. But these decisions can carry a really big impact into your retirement plan, your overall financial plan, your legacy plan for the next generation. Some assets are better now, some are better later, or some account types are better now, some are better later. So Brian, when we're talking about this in our committee, often a theme that comes to the top is where do we want growth versus where do we want income? And it's not a perfect always this account type versus that account type, but generally, where do we want the growth-oriented investments?
Yeah, if I had to choose out of those three pockets or three buckets you mentioned, I want to see high growth in my tax-free bucket first. If I can hit a home run on a stock, or if I have a portion of my portfolio that'll be exposed to more volatility, more growth upside, I want it in that Roth. And we're pretty consistent, I think, delivering that for clients where when we're looking at those different sleeves, we kind of push them to be a little more aggressive there. And of course, the idea there is if I'm going to grow something, I'd rather grow it tax-free than taxable, right? And so that's a good place to start. And from there, we kind of move down the chain. If I had a second best option for having something that's growing, I often want to see that in the taxable account. Not the IRA, not the Roth. The taxable would be the second piece. And the reason for that is the more favorable tax treatment when I achieve capital gains in a portfolio like that. I can choose when I buy and sell stocks. I can harvest losses if something goes wrong in my more aggressive portfolio, which sometimes happens. We call those tax assets that we harvest. So that's a nice financial advisor spin. If we lose you money, we're just developing tax assets, really. So, but that can be a good place to grow. And Cole, when you think about it, I mean, when we talk taxes on a capital gain portfolio versus maybe an IRA as a contrast, what kind of taxes are we talking about there? What's the margin?
Yeah, so in the example that we had this morning with a very specific client that we were talking about, potentially doing some rebalancing and reallocating their portfolio, we were taking some stock exposure off the table for this particular client. We were going to go get some more bond exposure. We were reducing risk a little bit in its most basic measure. And what we talked about is the fact that in their IRA, which was their largest particular investment vehicle, so pre-tax money, they had likely about an 75 to 80% net after-tax value. So just for easy numbers, if they had $1 million IRA, after taxes, every dollar that comes out is going to be ordinary income on the federal and state level. So if we're just assuming about a 20% tax rate for them, every dollar coming out is going to be taxed at that 20% tax rate. They have about an $800,000 net IRA or spendable dollars. If we were to contrast that, if they had $1 million taxable account with some embedded capital gains over the years, only the gain is taxable on that. So if their taxable account is $1 million, say they've grown, it's 25 or 30%, they've got, call it $300,000 of gain embedded in their $1 million taxable account. That means when they take the money out, only 30% of that is taxable. And that tax rate on that is generally, for most people, is only 15% on the 30% of gain. So if we're looking at the net effect of that, if they wanted to take money out, they're looking at over 90% is actual after-tax net spendable dollars. So that $1 million account, same balance, but in the IRA, the value to them in terms of lifestyle and expenses is $800,000 at most. In the taxable account, it's over $900,000. So which dollars are more valuable after tax? Generally, not for everybody, but generally the taxable dollars are where we want to try to grow that, because if we think about it the right way, tax deferred in the IRA, Brian, is not tax free. We're just delaying it until later, and it's tax deferred on the ordinary income tax level. So depending on how much ordinary income you're reporting, that can be quite a bit higher than your capital gains bracket. And so we can look at capital gains as tax deferred as well. We can generally time when we want to take those gains. Not all investments are as tax efficient as others, but we can generally time when we want to realize those gains. And if we only pay tax on the gains and the tax that's charged is less than your ordinary income tax bracket, then to your point just a second ago, trying to target more growth, putting more growth-oriented investments in the taxable account is normally better than the tax-deferred account, though this is often missed on do-it-yourself investors. Have you seen that before, Brian?
Honestly, I was thinking that, Cole, when you introduced this topic, this is one of those areas I don't think I've ever seen even a very intentional prospective client come in, someone who's been thoughtful about their investments, thoughtful about where they're saving, thoughtful about their taxes. I don't think I've ever seen someone come in that could describe to us their asset location decisions. This is an area where financial planners tend to bring a fair amount of value, in my opinion, if they're paying attention to this. So that's a great thing about our investment committee strategy is if one of us forgot to think about asset location, we've got several other team members that can step in and say, well, maybe we should reduce risk over here rather than over there. And I love the way you position that. So in summary, what you were saying basically is your Roth IRA is dollars because you get to keep all the money. There's no tax if you've held it for long enough, if you meet the rules. The IRA, in this case for this client, is around 70, 75, maybe 80% dollars. And the taxable account, like a joint account, a trust account, is over 90%, 90 cents on the dollar dollars. So I'd rather have those growing. What about income? Well, you mentioned that on the intro. If I've got investments like high dividend stocks, a real estate trust, MLPs, all these different asset classes that generate maybe high single digit to even low double digit dividends. Do I want those dividends also coming from my joint account or my trust account? Or do I want those dividends accruing in my IRA or Roth IRA? Where do those assets land?
Yeah, so when it comes to dividends or interest income, you want to be really thoughtful on how that income is taxed, because each one of those vehicles can be taxed a little bit differently. Are they qualified dividends? Are they non-qualified dividends? And this video is not necessarily to dive into that, but understanding the taxability of the income coming off of those particular investment vehicles. Another one I'd throw in there is bonds. There's different types of bonds. There's corporate bonds versus municipal bonds. There's high yielding bonds. But generally, broad stroke, those income producing assets, especially if they're highly taxable, if they're treated as ordinary income, you're going to want to house those in a tax deferred vehicle. And generally, you're going to want to err on the side of the pre-tax, the traditional side. You haven't paid taxes yet, think IRAs, 401ks. You're not going to want to target those in your Roth. Brian, you already said we don't even have to go further down that road. The Roth is generally the highest potential growth. Those are the most valuable investment dollars that you have because they're never taxed again. So get that bucket as big as possible, as fast as possible, as much as your risk tolerance and your plan needs that. But when income producing assets are introduced into the portfolio, which oftentimes, not always, but those can often be more preservation of principal, thinking about bonds, things like that, where they're not quite as aggressive on the growth side, but they have a place in your overall portfolio. And I'm going to lob this back to you, Brian. We have to kind of marry this overall asset allocation. Say we're targeting the traditional 60-40 split, 60% stocks, 40% bonds. We want that in the whole portfolio. But then we have to decide which assets we put into which bucket from an asset location perspective. How do we do that when we're trying to round out that whole portfolio? Does each account look the same, or are we having different allocations and different tax treatments? How does that look when you're kind of marrying those two pieces of this?
Yeah, and that's the way we position it as advisors is we first start with what you started with, which is how much risk do I want? What's my asset allocation? Am I a 70% stock investor? Am I a 90% stock investor? And what dictates that is your temperament, your risk temperament, and your growth requirements, right? We have a lot of clients, including the one we were talking about this morning. They have a moderate to low risk temperament, but they also have just identified through our financial planning process, they don't require more growth. If they did, we might have to write them a risk prescription and say, I know you want to be low risk, but if you want to do everything you say you want to do with your money, we've got to grow this thing. In their case, we could turn the volume down. So we started that conversation saying, this is the target percentage we're going to put in stock. So knowing your big picture, what do you want to achieve in terms of growth and volatility? Starting there is great. And then you can break out sleeves or categories of the portfolios that you drop into those different tax buckets, the IRA, the Roth IRA, the taxable. So starting big picture, then deciding how you can achieve that bigger picture through allocating investments amongst those different pockets, those different buckets, however you want to say it. That works really well. What we see a lot with investors is they sort of unintentionally land on an asset allocation on a risk level because, I have my 401k in here and that's always been pretty aggressive. I've never changed it and I always put money there and it grows. So that's now my most risky portfolio. With what we just said, that doesn't make sense. My cash over here, my trust account, I just kind of accrued that on accident by having more income than expenses. So it's all in the bank. So the part that we want you to grow the most is in a safe place in the bank, in a CD, savings account, money market. Your part that we don't mind slowing down a little bit and bringing some safe assets is actually your most aggressive. And then you forgot you even had a Roth IRA over at that brokerage over here, and that's not invested at all. So the most aggressive part is not invested either. So not being intentional here is not so much like a sinful lack of stewardship, but it's just an area where being more intentional could add value. The last thing I'd add here is some of our clients we serve have identified they have more than they'll ever need. So they're thinking less about my taxes during my lifetime. They're thinking, what does this look like as an inheritance? And I would say all the things we just said are true for inheritance as well, even more so. So the Roth, that goes to your heirs tax-free. The IRA will be taxable to your heirs if they receive it. If it's not a charity, those dollars will be taxable. So they're going to lose that same 20 or 30 cents on the dollar, or maybe more, if they're in a high tax state. And then even better on the taxable account, Cole, you talked about growing fairly aggressively your trust investments, your joint investments, those taxable dollars. Those get a step up in basis when you die. So if I own a stock for 20 years and then die with a bunch of appreciation, that gain is wiped away. It starts clean upon your death through a step up in basis that goes to your heirs. So whether you're going to spend these assets or your heirs will inherit them, the same rules should generally apply. And so this is an area where being intentional has a lot of value for multi-generational and personal planning.
Yeah, and Jesus even talks about the idea of being intentional. Whoever can be trusted with very little will be trusted with much more. This is something that doesn't just apply to those with big balances in their accounts. This is something you can start early on. And I want to be really clear that some of the general rules we've shared today are not true across the board. When you're 25 years old and you're investing, that doesn't mean you need to just buy bonds in your 401k. It has to fit into your overall plan. Yes, there's a time where accumulation, you're going to be very stock heavy, you're going to be growth heavy. That is the whole goal. It doesn't mean you need to go find income producing assets to buy in your IRA and you can only buy stocks in your other accounts. That's not what we're saying. There are no hard and fast rules on this. What we're trying to share is some of the considerations that go into this that you should start early on with your understanding of them. And it can be a little bit complicated, marrying the asset allocation with the asset location. And is this my money? Is it the next generation's money? I think ultimately we need to come into this with a biblical and eternal mindset that this is all God's money. And we're trying to steward this wisely as he's entrusted us as little miniature portfolio managers for him. And if we're not being wise on the tax front, what else might we be missing? And there's a lot of considerations that go into this to make sure that we are preparing for ourselves, but we're also trying to be thoughtful about the inheritance that we're preparing for the next generation. There's a lot that goes into this. So this is not meant to confuse or overwhelm or provide hard and fast rules. This is to try to just give you an idea on some of the thought process that's more than just how much stock and bond exposure do I have? There's a lot more to portfolio construction. Is there anything you'd add to that, Brian?
No, just summarizing, as you said, we should always be intentional. This is just another area to be wise stewards and be intentional. And it's a blind spot for a lot of people. Like I said, people don't come in thinking about this. So it's our privilege, and it's a great area we can add value to bring this to the forefront, be thoughtful about it, and then execute on it. So it's a great area for a financial advisor like us to add value, and we're happy to do that.
Yeah, and keeping an eye on what's your after-tax net worth. It's not just your net worth. If it's all in the 401k, if it's all in those taxed accounts, you want to just be thoughtful about that until you get to, lest you get too excited about a particular number in your account. You want to understand what that after-tax net worth really is. So we'll close there. So thanks so much for joining us on the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. If today's conversation was helpful, we would love for you to like the video, subscribe to the channel, and share it with someone else who might benefit. And for more insights and resources, please visit our insights page at johnmoore.com, where we regularly share articles and tools to help you steward wisely. And we will look forward to seeing you all back here next week.